Hi, everyone. Welcome to the Small Cap Discoveries One-on-One. Today on our call, we have Chip Maloney. Chip is a private investor and well-known amongst the microcap community, being both a member of Microcap Club and Small Cap Discoveries. I'll now introduce our host, Paul Andriola, and let him take it from here.
Awesome. Thank you, Trevor. Really happy to have Chip here with us. Chip and I go back a number of years. We've met up at a lot of different conferences, and always great to catch up with Chip. I'm going to start the whole thing by stating a disclaimer. I want to make sure everybody understands that we're not going to be giving any sort of investment advice. We are not registered advisors. Today it's really going to be for information, entertainment purposes only. So I want you guys to understand that we may talk about stocks, we may own these stocks, or we may not. But please don't consider anything that we say today as investment advice. So with that, I want to say hi to Chip. Chip, how you doing?
Doing well, Paul. Thanks for having me.
Right on, right on. So Chip, you're a member of the Microcap Club. We keep running into each other every time we go to some fancy conference. I certainly think you're one of the better microcap investors that I know in North America. And really want to know how you got into this crazy space, and really who is Chip, and I mean, really, why microcaps, my man?
There's a few questions in there. So
Yeah.
Who's Chip? So that's a pretty deep question to start with here. So I guess I'm a husband and I'm a father. I'm a volunteer youth sports coach. I'm a long-suffering Oilers fan. And I'm a private investor that I do investing in my spare time. My day job's in healthcare, but I've been investing for about 20 years. How I got into microcap, so goes back to, we'll go right back to my first investment ever. So 12 years old. And so we grew up about a block away from a 7-Eleven, and so I'd get my allowance every Saturday, and I'd run over to the 7-Eleven. I don't know if you remember back when we were growing up, the convenience stores, they had the big arcade style video games, right?
Absolutely.
And so I'd run over there, I'd $3 in allowance, and so I'd spend $2.50 trying to set a high score on track and field or karate champ. And then I'd save a little bit of money at the end just to kind of take a stroll through the candy aisle and pick out my favorite chocolate bar or whatever. And so there was one Saturday I was walking through the candy aisle after, I think I set a couple high scores on karate champ. And I noticed that caramel chocolate bars were on sale for 25 cents. And I thought, that's a good deal. I can afford two of those with 50 cents I've got left over here. So right beside that, I saw there was a little coupon for a rebate. And so you get 40 cents back for every chocolate bar that you bought. And so 12 years old, I did the math in my head and subtracted 25 from 40 and realized I could get paid to eat chocolate bars. And so I ran home to my piggy bank. I pulled out probably half of my net worth, which is about 20 bucks at the time. And I ran back to 7-Eleven and I bought as many chocolate bars as they had. And that was kind of, for me, I mean, it's a funny story, but that was the first time I realized that you can actually put some money out and you can get your principal back plus some extra, and you can get paid to eat chocolate bars. So, so I'd love to say that shortly after that, I started investing in stocks, but it was another 12 years. And so most of my money, I was always good at saving money, but I was saving just for university. And so all my money was kind of going into savings, and did, the comic book sort of speculation in the teen years. And then my mom sort of got me investing in GICs just to get a little extra interest on my money for university. And then when I graduated and I started working, so I had started to have a little bit of disposable income. And so I figured, well, I had read The Wealthy Barber. My parents had given me that in university. And so anyways, I figured, The Wealthy Barber talks about investing in mutual funds. And so I went to the library, did a couple hours of research. I found the highest performing mutual fund in the last 5 years, and I figured that's it. It's my ticket to retirement, and so ran down to this would have been late '99, early 2000. And so the mutual fund that I had found was it was a science and technology fund, and right kind of at the peak of the dot-com craze. And so anyways, went down to the bank where I've got my savings account, and talked to the mutual fund representative in there, and I told him what I wanted to do, just an automatic investment plan. And he said, you know, there's a lot of risk in that, right? I said, yeah, no problem. I've done my research, and I'm a long-term investor. It's okay. We'll be good. And so, you know how the story goes. And 3 months later was kind of the peak of the NASDAQ bubble, crash later. I think I lost, you know, it was cheap tuition because I just started to invest. And I think it was down 60% within probably 2 months. And so went back to the drawing board, obviously, and said to myself, I kind of have to figure this investing thing out. And so back to the library. One of the first books I picked up was a book on Warren Buffett. And I think it was Janet Lowe who wrote, it was, I can't even remember it. I mean, it's 20 plus years ago, but I think it's like Warren Buffett Speaks or something like that. And it's just kind of some of the quotes that Warren Buffett has had in his annual letters over the years. And it just made complete sense to me and so it took me about 2 minutes to get the value investing bug. So from there, he talked about Benjamin Graham and Phil Fisher, and I'm sure a lot of the books that you've read. Seth Klarman, that led to Peter Lynch, Joel Greenblatt, just studying all the investment grades. And so early on, reading The Intelligent Investor and Security Analyst really struck a chord with me. And so early on, I would say sort of my investment philosophy was kind of deep value. You know, I did a lot of you know, like cigar butt stuff, like cheap book value stocks. Back like after the dot-com crash, there was Sarbanes-Oxley came into effect in the States. And so a lot of these companies were starting to go dark. They didn't want to file with the SEC anymore. And so they were doing these, what are they called? I think reverse tender takeouts. So they were just trying to get their shareholder numbers below a certain level so that they could go dark and stop filing with the SEC, because just the financial costs were just really onerous for these tiny companies that only had maybe 3 or 4 million in revenues. And so there were little situations where you could, you know, they had to get below like 50 shareholders, I think. And so they would do like 1,000 for one reverse split. And so if you held under 1,000 shares, you could get like 70 cents. And so, you know, you couldn't put a whole lot of capital to work, but it was a good way to kind of build a grub stake. You know, I did early on, did a lot of kind of microcap kind of arbitrage. The spreads used to be a lot wider than they are now. And so for anybody, probably most people know what arbitrage is, but a company announces that they're taking over another company and taking them over at $1. You know, the stock will move up to 85 cents. You got 3 months to make 15 cents on that investment. And it's a pretty high annualized return. So did a lot of that sort of thing. What else? Closed-end fund kind of discounts. You could find these things trading in the market. A lot of liquidations. And so, but just over time, I mean, you can't put a whole lot of money to work in those smaller sort of situations. So, so over the years, I mean, it took me probably 15 years to kind of move towards more investing in quality companies. And so over the period of time, I moved more towards trying to buy really good companies at really cheap prices. And for me, just there were a few kind of early situations that really moved sort of my thinking in this regard. And there was, I don't know if you want an example, but early on, there was a company called Grey Horse Capital. We talked about a little bit on that free for all. And it was trading, it was a capital pool company. And so they came public. I think they came public at $1.50, but it was trading like around 56 cents, I think it was. And they had like 25 cents in earnings per share. But you had to dig through all these, the filing statement. You had to, maybe it was on page 60, there was just a little blurb, we earned, $1.5 million last year, and market cap's like 3 million. And they grew, I think 30% the previous year, high return on equity business, and like it's everything we look for, right?
Yeah.
And it's trading at 2 times earnings. And so anyways, that was kind of, the way I found it was, I was just reading through the Financial Post we used to get the paper edition.
Mhm.
And on the, they used to, I think it was Roynac Capital, they used to, they lent to a lot of these smaller public companies and private companies. And so they had lent some money to them. I think they did a convertible debenture. And so anyways, came across it. It was just sort of almost like a promotional advertisement. It's like, this is what we do. We lent this company some money. And so I thought, that's interesting. And so I started digging into it, and sure enough, it was, I think it was up like 20 times in 2 or 3 years. And so for me, that really was another aha moment where, these situations don't come around very often, but if you're patient and you can wait for these things, like, I mean, it's just like, it's just gold laying on the ground when you find those things. So anyways, that was a big thing, but it took me another, I think, 10 years after that to really transition kind of fully to trying to own quality companies. Yeah. And I still do some cigar bet stuff. Like back there was a lot of stuff. I mean, pretty much anything you bought in March, you just knew was probably going to turn out well. Eventually, who knew it was going to bounce back that quickly, right? And so there were a couple of real estate, like land development companies in March that were trading at like 0.2 times the book value, and the book value is understated from what they're carrying it for. And so I still kind of do a little bit of that, but most of it's kind of sort of gravitated towards quality and trying to buy things really cheap. So get those two together, I find that usually works out pretty good. So
yeah. Right on. Well, I mean, you touch on it a little bit maybe, but how do you now, how do you find your ideas? What do you do to find, the great little ideas?
So, do a lot of things. Obviously, I have a network. I've been super busy the last 2 or 3 years with coaching and some volunteer activities. So it hasn't given me the time to sort of nurture my network as much as I'd like and collaborate. But that's, I mean, when you find other really smart investors and you can collaborate on ideas, I mean, that's just, it just works so well. I do a lot of reading. I know you guys scan CEDAR filings every day. Because I have a limited amount of time, so I've sort of hacked that even further. I use something called Stockwatch Daily. And it's just a publication, so 40 pages, usually every day they put it out. And it's got broken down by industry. For anybody who doesn't know what Stockwatch Daily is, they'll break it into the industry. So I can skip past the first 20 pages, which is mining and oil and gas. And so it's just a more efficient way for me to screen out ideas. Because I can't get to that every day, a lot of the times I'll just scan through it every week or two. So I can't find, I usually won't get those ideas that it's like, holy cow, that, they grew their earnings 100% this quarter. I mean, I'm going to find that probably a week or two later, but for me, it's a pretty efficient way to kind of screen through sort of all the the latest news releases. What else? Yeah, CEDAR. Back when, so you asked the question, how did I get involved in microcaps? And so when I first started investing, soon after I lost most of my money from the Science and Technology Fund, I came across something from Buffett, and he said, someone asked him a question, if you had $1 million, what would you do? And he said, I'd go through every stock basically and start with A, and I'd go all the way through, go to Z, and you're going to find little kind of wrinkles in the nooks and crannies of the market. And so I did that. So I spent, you know, a couple months sort of looking at every single company, whether it was resources or mining, or obviously now I don't do any of that, but at the time. And at that time I was just looking, not necessarily any price on these stocks, but what I was looking for was, you know, maybe a company that might be unprofitable, but maybe they have a division that's earning a lot of money and another that's losing money. So I'd kind of put that on my watch list, looking for companies that had a lot of maybe cash on the balance sheet. So anyways, I built a stock watch list of probably 300 companies at that time. Just watching what kind of the great investors did. A lot of them got their start in microcaps. And then a few of the fund managers that I came across that really respected, like Tim McIlvaine and Francis Chu. So they were doing a lot of stuff in microcaps. And then I read Jim O'Shaughnessy's book, What Works on Wall Street. And in there, I mean, and it was funny because he said, you know, the best performing asset class is microcaps. But basically at that time, I don't know, it's probably changed, but he said basically they're uninvestable because the spread's so wide. Yeah. And so I started looking at these small companies and I'm like, these spreads aren't that wide. I mean, right. You know, they're wide, but so those were sort of the things that sort of steered me towards microcaps. But I just, whenever I'm doing something competitive, I don't like to have competition. And so, you know, if you can get into some of these names where even funds with $100 million dollars in assets, they can't even look at these things. And so it's keeps, you know, if there's 150,000 CFDs in the world and, you know, only a few of them can compete with you, I think it's a pretty good thing, right? So
scary to know there's that many, but okay.
Yeah.
So would you call yourself now that you spent, it looks like at least 20 years sort of investing, would you call yourself now a value investor or a growth investor?
I think I would identify myself. I mean, some people would probably still call me a value investor, but I would probably identify more with growth investing. And, you know, the main strategy that I use, I call it Gulp Investing. So a lot of people have heard of GARP, which is growth at a reasonable price. And so Gulp stands for growth at an unreasonably low price. And so, you know, basically I'm trying to buy growth at a value price, at an extreme value price. You know, Eric Sprott, he's one of the best small cap investors ever. And you know, you probably studied him back in the day, but you look at some of his, he calls it stealing value. And that's kind of sort of how I feel about it when I'm finding some of these things at 2 or 3 times earnings every couple of years or 3 years. And you're just trying to steal value. You're looking out, you know, 3 to 5 years. I'm trying to buy these things at about a quarter of what I think they're going to be worth 3 to 5 years out. And if you can do that, if you're right, if your valuation works good, I mean, it basically works out to a little over 30% annualized returns. And obviously, you know, we're probably only going to be right 2/3 of the time, if hopefully. And so, you know, even if you're wrong on a third of those, you're still going to do pretty good. But it's worked out pretty good so far. So.
Yeah, no kidding. Yeah, I agree with you, Eric Sprott, especially back in the day. He's a lot more of a resource guy, but back in the day, he was just phenomenal.
Absolutely,
what he was able to do.
And that's sort of the period that I've studied is, you know, when he was buying, what was that armor company? I can't remember.
There was one called Ceramic Protection.
That might have been it. Yeah, he was buying it for like 2 times earnings, but it was 2 times earnings a year or 2 out, but you didn't know what the earnings were going to be. Hurricane hydrocarbons, which is resource, but like I think he was in Bowflex.
He was in Bowflex. That turned out to be one of his best returning stocks he's ever owned. And the reason the way he actually found out about it was through a newsletter that I was producing as a broker. So I'm gonna claim that for him, that I helped him get his biggest win ever, but I'm sure he might have a different view on how he figured it out.
That's awesome. That's a great story.
Yeah. No,
And then
that's-
Taser he was in as well. I think
Yeah.
that was like a 100-bagger over like 2
Yeah.
years, I think.
Yeah. Well, he was managing one of the like the highest returning funds in all of North America. Like it was just staggering the returns he was generating. And it was all mostly Canadian microcaps. That was the bulk of the portfolio, was Canadian microcaps. So that and I want to refer back to Jim O'Shaughnessy, that book. I agree with you. I mean, that really solidified for me that microcaps is where we want to be playing if we want to consistently outperform everybody else, and it's been true to form. So that's awesome. So you mentioned a little bit that you stay away from mining and resources. That's what we do as well. But are there sectors that you just like more than others? Is there anything you can do on?
Yeah, so I think I would classify myself as a generalist, but there's definitely some areas because of my healthcare background. I feel like that's in my wheelhouse. Feel pretty comfortable there. Like right now, probably 30% of my portfolio would be in healthcare. Feel pretty comfortable, even though I'm not a tech guy. I feel comfortable investing in software stocks. It's just a really good business model, sticky business, high switching costs once you sign up the customers. They usually have pretty good moats, even the small ones. I have 3 stocks in my portfolio that are online marketplaces, and so I've in the last year I've sort of done kind of a deep dive on the online marketplace sector, and then beyond that I'll have a smattering from all different kind of industries. And so I just figure, if you're walking down the street and you think, well, I'm just gonna, if I see a bill lying on the ground I'm only gonna pick up $5 bills. I mean, you're just gonna walk right past $10 bills and $2 bills, right? I mean, it just doesn't make sense to me. So, obviously there's a circle of competence sort of thing to it, but I think any investor who is willing to put in the time to learn an industry can. So, if it's something that looks cheap to me, I'm probably going to spend some time on it, especially if there's some growth there. So,
so Chip, correct me if I'm wrong, but you really don't have a financial background, do you? Like you have
Zero.
a background?
Zero. I attended one economics class in university, so for my undergrad, I had to take a few courses outside of the Faculty of Science.
Yeah.
And so I signed up for economics because I thought, we'll give this a try. I went to the first class and I just thought, this is so boring. When am I ever going to use this? And so I wish I had stuck it through. So I'm reading an economics textbook right now. So
well, in the world today, we're seeing what's happening with GameStop and just the machinations of all the different interest rate gyrations. I don't think there's an economic book in the world that predicted any of the stuff we're living through.
No, I agree.
So,
I don't think the best economists in the world understand what's going on.
Exactly. So I think you didn't waste any time. I think you did right. The way you did.
But I have, over the last 20 years, I've probably read, I don't know, I bet you 500 or 600 books on investing, and everything sort of attached to it. I mean, to be a good investor, you have to have such a wide breadth of knowledge. Yeah. And so, I learned accounting, valuation, behavioral finance, how to think about making decisions under uncertainty. All these different areas. So, but I don't have any financial letters behind my name, and probably never will. So,
and you know what? It's amazing how much of a common denominator that is for investors that I find are really good at this, is that they don't really have a formal background in it. Mm-hmm. I think that probably the value, all those books you read, I've probably read just as many books as you have. Exactly. What I find is that we read them to apply ourselves to how they're going to affect our investing, rather than going and taking an accounting class because I want to be an accountant. I'm learning accounting because I want to know how I can read an investment statement better, right?
100%, yeah. Well, and for the first probably 10 years investing, I thought I was at a disadvantage because I didn't take a kind of traditional finance sort of path. And I know coming from, like, I spent a year as a research assistant in college. And I never really appreciated kind of what sort of that benefit gave me, but just sort of approaching everything kind of from the scientific sort of method framework and just critical thinking. Like we used to spend an hour every week just kind of critiquing a medical journal article, and just I think just sort of ingraining those habits in my brain, you know, questioning why is this, why this doesn't make sense. There's some bias in this part of the study, and so their conclusions, you know, they most of their study participants were women, but they generalized the conclusions to, you know, kids and men as well. And so just being curious about things. And so I think sort of, I never appreciated that, but I think sort of that part of my training, I think has been a benefit. So, you know.
Cool. So let's ask this. You stumble on a company that looks interesting. Walk us through sort of your due diligence strategy. Do you call management? Where do you look for validation? Do you look at financials? Tell me what you do before you pull the trigger.
Yeah. So usually what I'll do is I'll do a sort of a quick glance. I'll look at the description of the business. And from that, I'll just try to figure out, is it something I understand? And is it a good business and with some sort of sustainable edge? And so from there, if it kind of passes that filter, then I'll go on and probably look at the financial statements. And so I'll start at the balance sheet, kind of sort of do sort of a quick calculation in my head. What is the tangible capital in this business? And so I'll take the current assets. I don't know how deep in the weeds you want me to go here, but so I'll take I'll just figure out, are they returning a pretty good return on their capital? And then I'll flip over to the revenue income statement and have a look and just see, is this business growing? And are they profitable, or at least near profitable? You know, I think you're gonna filter out some ideas that, like, for example, software businesses. There are a lot of software businesses that are burning through a lot of cash, but the unit economics of the business are positive, right? And so each customer is profitable, but when you look at on the income statement and the cash flow statement, it looks like they're burning through a ton of cash. And so I'm looking for those sorts of things. You know, usually the companies I'm looking at, if their price is kind of sort of a little bit further on after I've looked at the quality of the business. But usually these companies, they have to have some sort of kind of black cloud or overhang or something on them. And so what I try to do is I've got these kind of 4 buckets that I sort of lump these companies that might have some sort of overhang into. I can go through that if you want.
Sure, yeah.
So the first, I watch quite a few movies, and so I lump these buckets into movie titles. And so the first bucket is Rocky. And so Rocky, as you know, if you've seen, I've only seen, I think, the first 3, but in Rocky, he gets punched in the head a lot. And so sometimes companies get punched in the head. Just they're walking along the sidewalk and out of the bushes comes a bully and hits them in the head. A lot of the times the bully is the government, or it can be an incumbent in the industry. And so things like patent lawsuits. There's a couple of companies I was buying during tax loss selling season 1. There's an antitrust suit against them. So it was just announced, the stock dropped like 20% on that. And then another one, there's CRA, a Canada Revenue Agency dispute. And that's been going on a little while, but you know, those sorts of things put an overhang on the company and allows you to get some of these things cheap. The second bucket I call Beauty and the Beast. And so there's, you know, they can be kind of one part ugly and sort of one part beauty, or a couple parts ugly, one part beauty. So MTY Food Group, which you would know. So back when it was trading at 25 cents, they had a tech division that was burning through a lot of cash. And then they had the food franchising business that was earning a lot. But if you went through the filter, I think they were losing money at the time. But if you dug down into the statements, you could see that they were earning actually quite a bit of money from the franchising business. With those, you know, that can go on, and there may never be a catalyst, but those sorts of things, if you have them on your watch list, you can come back when they announce that they're either maybe divesting the unprofitable business or maybe shutting it down. That's usually a pretty good time to invest. And that's what MTY did. And that was, I think that was a 20 bagger in a couple of years.
Yeah.
And then I would put Route 1 in this class too. I wouldn't say it's Beauty and the Beast, but there's you know, a part of the business, a horror business that just doesn't seem to be quite as attractive. But if you get to, I think it's like page 13 of the investor presentation, you see the MobiKey division, and you see this high margin, you know, almost 100% gross margin software business that's growing like a weed. And so that would be kind of the second bucket. The third bucket, I call Curious Case of Benjamin Button. Have you seen that? And so I call them Benjamin Button stocks. And so if you've seen the movie, you know that Brad Pitt, he plays the character that he plays. He's born as an old man, and then he goes through life and he gets younger and younger and stronger and stronger. And so some companies are perceived like a buggy whip company or like a melting ice cube. And the reality is that they're actually getting better and stronger. So, you know, we've talked about Ready Shred before, the paper shredding industry. A lot of people think it's kind of a buggy whip industry, but, you know, if you dig down into it, it's, I think it's a growing business. And then, I know, I don't know if you still own it, but NAMSA, same thing, like cash management, right? And so a lot of people think that cash is going away, but it's a business that's doing really well. So, and then the last bucket of sort of stocks I'm looking for, I call them Forrest Gump stocks. And so they've got very, very low expectations, but they have the potential to turn into hidden champions. So that's a pretty big bucket. That's probably where most of the stocks that I own would sort of come from. And so, you know, it could be something like maybe earnings are growing 20% a quarter, and then they have an earnings miss. And so all of a sudden there's low expectations. As you know, there's a very big difference between the value of a company growing at 2% a year and 20%. Like, you know, if the value of a company is the future cash flows discounted back, it's just an enormous difference. And so if the market thinks that this company is now a 2% grower, and you have a kind of a variant perception that this company can continue to grow at 20%, then that's a pretty good place to look. Another area under that sort of Forrest Gump bucket. So companies are kind of moving up the value chain in the industry. So I would put ImmunoPrecise in this bucket. And so, I mean, you know this company way better than I do, but just sort of to give an example. So starting in kind of the lower margin diagnostic end of the antibody industry and moving into more the therapeutic end, and, you know, developing preclinical antibodies, and then maybe even moving into manufacturing. So companies that have very low expectations at the time can trade for very low multiples. But if you look out 5 years and you have a reasonable sort of idea of what the company is going to look like in, you know, 3 to 5 years, can be a pretty good spot to find companies. Spin-offs, so it's another area that often have low expectations. So you guys were involved with Viamed. So, you know, Viamed, you know, they came public. It was the promoters that were involved with the predecessor weren't, you know, I don't think it was all deserved, but they didn't have the best reputation on Bay Street. And so to that, I mean, you already eliminate like 90% of the competition right there. And so, but if you followed the business, Casey Hoyt was the CEO at the time. He came in after they bought Casey's company, Sleep Management, and that's kind of where the Viamed business came out of PHM. But they realized pretty soon, I think after they were acquired by PHM, that they wanted to separate again. But when it came public, like, I mean, it was, again, a 400-page document you had to kind of wade through. And I think it was probably on page 200, there was basically one relevant page out of 400. It was the financials for the last couple of years. And, you know, if you did the math on it, it was trading at, I think it came public. I think I was the second trade on it at $1.65. And it was at that price, it was trading at about 4 times EBITDA. So, and just really, really good business. They had grown 40% the year before. And I mean, you just, you know, there is a risk that Medicare could potentially cut the, basically they provided, you know, this, but they provided services for ventilators for patients who have COPD. And there's always a risk. They already had a cut a couple of years before. But if they did that again, I mean, that could really knock out their margins. But if they didn't, I mean, it was a beautiful business, and it worked out pretty well. So,
and listen, I got to thank you, because we were relatively early, but I think you were the guy that really tipped me into it in a pretty big way. Because I think we were buying it around 220 or 230, and yeah, we had a really good run on that. I think it's, what is it right now? $14.
I think, yeah, I think it's a little lower than that, but I think it did definitely go up to 15. Yeah. But you know, when you follow these companies, like I've sort of scaled out of it as it went up that first time, but then in March it came back, actually even before the crash. They had an earnings miss, and you know, I can't remember the exact numbers, but you know, everybody's expecting them to grow about 30%, and they printed like a 23% increase quarter, and it just got hammered. And so it came all the way back down to about the valuation where we were buying it at the spinoff. So, you know, sometimes if you follow these companies over many years, you get the chance to invest 2 or 3 times in these things, and usually works out pretty good. Not always, but
no, exactly. I wish it was always. Okay, so listen, you gave us examples of all the different movies you got here, except the Rocky. Give me examples of Rocky that you can think of right now. That gets pummeled every now and then. It sounds like me when I was a geeky little teenager getting beat up on the way to school.
So there's a little company you'd probably be familiar with it out in Vancouver, and so it's called Glacier Media.
Okay,
so it's a business. It would sort of fall under a number of these buckets. So very low expectations. So you could call it a Forrest Gump one too. You could call it probably a Beauty and the Beast too, because it's got a few little really nice gems in it. But the Rocky part is, so they got slapped with the Canada Revenue Agency. Basically, if you go way back, they acquired a company for the tax loss assets, and so they were using those tax loss carry forwards to offset their income, so they didn't have to pay taxes over a number of years. And then the CRA started to crack down on that, and so they got basically a notice from the CRA saying, you know, you owe us $30 million. And at the time, I can't remember, it was probably in 2015, I'm thinking. Might have been even before that, maybe 14, and the market cap might have been 100 million in that time. And I can't even remember what it did. It's one of the first stocks I ever owned, like 20 years ago, and I scaled out of it, sold quite a bit of it, just as the newspaper business sort of started to deteriorate. And then I just re-entered it in December on tax loss selling. And so that would be an example of that, the gem part. So I don't know if you have looked at any real estate in Vancouver at all, but what would you use? What platform would you use to look for real estate online?
Oh, okay. So I think I know which one you're talking about. Real estate, rew.ca.
Yeah.
Glacier.
Yeah, exactly. So they've got a really strong offering in BC. I think they're most people in Canada, they use realtor.ca, and so to find real estate online. And so REW has more users in BC now than Realtor. So they're trying to expand out to Alberta and Ontario, and it's kind of a question mark whether they can be successful or not. So Yeah. But the rocky part is they got hit in the head by the CRA. So
we all do from time to time. At least it feels that way.
Exactly.
That was really clear. Okay, so give us a sense of how you buy and sell. Like when you find a great idea, do you jump in both feet? Do you sort of leg in, or how do you do that? And then same thing on the way out. What do you look for when you're selling?
Yeah, so it varies. It's not super graceful, but there's been times like to go back to the Gray Horse Capital example, like I had a full position within a day on that, or 2 days. I mean, I had a pretty small amount of capital, so it was pretty easy. A lot of the times like Glacier, so I've been following that for 20 years. I mean, I've read every single quarterly statement on that over 20 years. And so I felt like, a company, maybe if I've been following it for a while, I finally might see they're at an inflection point or a transition point. And so, I mean, I'll just start putting in bids, and it might take me a couple months to build a position. There's a company last year, it was a net. And it took me 9 months to build a position in that. And so, but I was a little stingy on my price, so I probably could have got a lot more quicker. And then, yeah, there's other stuff. I'll take a lot longer to buy it, but I bought stuff, if it's trading at 2 or 3 times earnings, and I don't think the situation is going to last long. If I think it's going to go up a lot, like Gray Horse, within a couple of days it was at 70 cents and I was buying at 56. And so I'll enter it with 15 or 20 minutes of due diligence. Like I can always sell later. And it's interesting. I was just reading, there's a fund manager, I don't know if you've heard of him, Nick Sleep. He's in the UK. No. And very successful fund manager. I think he did like 20% a year over 12 years, which for a fund manager is phenomenal. Yeah. And I can't remember I'll probably butcher sort of what he was trying to get at, but he was saying, maybe we're doing it wrong by trickling into these stocks. Maybe we need to take a full position like the first day. And if we do that, basically, it means that we've done the due diligence on it and are ready to buy a full position. So I think that's kind of extreme, but it's kind of an interesting thing to think about. So, but yeah, for me, it's all over the map. As selling, same thing. So selling, just with my experience watching some of the great microcaps in Canada, like MTY and Expel and Bioscience and Gray Horse Capital, my thinking has kind of changed. Like there's a big movement right now to sort of hold these compounders and never sell them. And for me, I think if you're trying to compound your capital as fast as possible, I think about like these big winners like Expel, like I know you're in way earlier than I was, but even from $1 to where it is now, 52 or 53 bucks, it was trading at 6 times EBITDA at the bottom, like at $1. And now it's trading, I think, it's probably like 60 times EBITDA trailing. And you get most of the increase in that stock price has been multiple expansion. And so I sort of think now about when I'm looking at buying a stock, if I'm buying something that's cheap and growing, I think of it almost kind of like an S-curve for the multiple expansion. And I'm trying to buy it kind of where the multiple is low at the bottom of the S-curve. And I'm starting to exit, something like Acuity, I exited that way too soon. But, personally, I think maybe it's gotten a little ahead of itself, but I could be totally wrong. But I'm trying to catch the biggest part of that S-curve that I can in the multiple expansion. And so like MTY, I went from like 2.5 times earnings to 20 times earnings in 2 years. But yet the earnings grew, I don't know, maybe 50% in that time. So you get a lift, a 50% lift from the earnings, but you get a 10 bagger just on the multiple expansion. So that's kind of how I think about exiting now. I'll sort of, when I enter a stock, I'm sort of figuring out what's the expected return over the next 5 years, and sort of in my head. I mean, it'll vary, but in my head, I've got this idea what it's going to be worth in 5 years. And if it gets there in a year, I mean, I'm probably out of it. So, and other stuff like, I mean, I'm wrong probably at least a third of the time. And so, I mean, I'm probably slower to sell that stuff than I should be. You know, sometimes I'll hold stuff that I should probably have blown out a long time ago for, 3 or 4 years. But the stuff that doesn't work, though, it becomes a smaller and smaller percentage of your portfolio. So sometimes I leave them in there just to kind of rub my nose in the mistakes.
It's funny you say that. You know what? I've got probably one of the biggest losses I've ever taken. It was a company that basically it got what we call dotted. It went to zero, right? And every year, at the end of the year, my brokerage firm tells me, "Hey, do you want us to remove this from the portfolio?" And I say, "No."
Yeah.
Because I want it to be there to remind me of the mistakes I've made, right? So yeah, I hear you.
Well, I've heard some of these cases though like that. It hasn't happened to me yet, but I've heard a friend of mine had a stock that he was thinking about doing that, getting it removed, and he just left it in there. And I don't know if there was like a class action lawsuit or something that he got like I think it was like a $20,000 or $30,000 payout on it. And so I don't think, I mean, it takes up mind space a little bit, but I think it's worth keeping them in there because you never know.
You never know. Yeah.
It could be a little lottery ticket or something.
Fingers crossed. Yeah. You never know what can happen there. Well, that's great. So I mean, we talked about microcaps right now, but do you invest outside of stocks? I mean, do you buy real estate? Do you still buy comic books? Are you still out there buying chocolate bars or whatever it was?
Yeah. If I could find caramel chocolate bars on sale again for 25 cents with a rebate, I mean, I think I'd go to every 7-Eleven
Absolutely
in my area. But we have some real estate investments, nothing income producing at all. Got some recreational property. I do invest outside of microcaps and stocks. I do a little bit of warrant investing. I think I'm pretty good at valuing what a company is worth, but I have no idea when it's going to be, when the market is going to agree with me. And so a little bit of warrant stuff. I've done a little bit of leap investing, so just long-term options, but I mean, I can't understand like the GameStop stuff, like these guys investing 100% of their net worth in, or more in, short-term call options. Like that's just, to me, that's insane. I mean, it just doesn't even register. So, but if I'm investing some of that stuff like warrants or options, it's usually 2 or 3 year expiry. And usually if I'm right on the valuation, usually the market's going to agree within 2 or 3 years. So usually gives me enough time. But and then I do some stock investing outside of microcaps, and so a couple of my holdings are some of the biggest companies in the world right now, and I've got some holdings in Chinese companies, India, Latin America, Africa, and so they're all kind of domiciled or they trade on North American exchanges.
Okay.
But yeah, I mean, like I said, if I'm walking down the street and I see a $5 bill, I'm not going to walk past it if I'm just looking for $10 bills. So
I like that.
Who knows if it'll work out?
Exactly.
But, I mean, there's a lot of microcaps, because usually they've only got 1 or 2 divisions. They're really reliant on a smaller portion. They're reliant on one industry or sector for their success, and so there's definitely a little more risk in microcaps, financing risk all the time, right? And so as I've sort of invested for a little longer here, just kind of diversifying a little bit outside of microcaps, but yeah, microcaps are still sort of my first love in stocks. So. But right now, I would say probably 50% to 60% would be in microcaps. I don't know what our definition is in Canada, but under 150 or 300 million, I'd say probably 60% of my portfolio is small good companies. You know.
Yeah. Okay,
These companies, they get a bad rap sometimes, but I mean, there's some amazing management teams running these phenomenal businesses.
Yeah.
And when you find them, I might not hold them forever, but if you can kind of hitch on for the ride with these guys, it works out pretty good. So
yeah, no, there's been some absolute rock stars, and I agree with you. Just because they're small doesn't mean there's some good management teams out there. Certainly seen some good ones. How much time do you spend dealing with or looking at the macro environment? Are you bottom up only, or do you look at the economic trends?
I feel like I've got a limited amount of time to do research, and I probably spend maybe 15 to 20 hours a week on investing. And probably, I would say probably a good 5 hours of that, I'm just trying to sort of improve. And so reading something, just trying to expand my area of competence into different industries. And I give very little time to macro stuff. Like if I'm scanning through the Financial Post, if it's some macro thing, I'll usually probably just skip past it. And having said that, there's guys like Jeremy Grantham with Grantham Neo, or I can't remember what the name of their firm is. Like every once in a while, like back in 2008, like that was kind of a scary time. And so I don't pay attention to macro until I need to pay attention to macro. And so like back in 2008, like the world was just falling apart. It's like what's happening here? Like our financial system, if the Fed doesn't, or if the government doesn't get involved here and help fix this, like what's going to happen here? And so anyways, in 08, that was, my first big bear market. Like I had kind of seen the 2000 to 2002, but I didn't really have anything invested then. But in 08, so I started reading, right in the thick of the crisis, Jeremy Grantham, and there's a book called This Time is Different. So they went back and they studied like 800 years of these financial crises. So I'm just trying to like sort of speed read through these books and sort of figure out sort of in real time what's going on here and what's likely to happen. But other than that, like I really don't spend much time at all thinking about that. I know Peter Lynch says something along the lines as if you spend 13 minutes a year thinking about macro, it's a waste of time. I absolutely see the value in it, just sort of from a top-down sort of perspective. I don't have the time to spend on that, and I just don't think for me it would be a worthwhile use of my time. So.
Yeah. I don't disagree. I think the noise around macro and all the different economic viewpoints I find are very hard to invest around anyway, right?
Yeah.
How's it going to affect a microcap that I'm looking at? Probably not too much. So.
Well, and the other part of it too is if you're if you're investing kind of from a macro standpoint, I mean you're investing against George Soros and what's his name from Duquesne Capital, just like some of the best macro investors that have spent their lives and they have access to all this data, and so definitely not investing based on that. Having said that, now I'll like in February, I was probably 30% cash at the end of February, just because I saw this is kind of an uncertain time right now with COVID. And how it could impact things. It looked like it was starting to impact the global supply chain, and even if it was that could be result in some sort of chain reactions. So I didn't do a whole lot of reading on that, but at times I'll increase my cash position. I mean, if it turns out that the negative winds pass, then I can get reinvested pretty quick. But even right now, I'm probably sitting around 15% cash. So
okay,
I've got no problem with that. I mean, I think if you're trying to maximize your returns, you're fully invested all the time because I mean, you know, your opportunity cost is, you know, if you can do 20 or 30% a year, you're sitting at 0% cash. I mean, you're gonna impair your returns. But it suits my personality to hold a bit of cash, so I'm super risk averse. So.
That's great you said that, because I think everybody's got to understand there's their personal psychology and build a strategy around that. So that makes complete sense. And whether you want to pick stocks or whatever, but where do you see the opportunities in the marketplace right now? Are there sectors or literally specific stocks? Maybe pick a couple ideas. And I want to reemphasize, you're not an investment advisor, so anything you say here is really your opinion only. So feel free to sort of say whatever.
Sure. So right now, these are tough markets. Like, everything is going up, and it's tough to find value right now. Especially if you've got a pretty high hurdle rate. It's really tough to find stuff that sort of meets my criteria. There's an idea that, so this is a net I was buying last year, and so it's sort of the next episode of the Biomed saga. And so this, I think we talked about this before, but it's a company called Salona Global.
Yep.
And so they're in the healthcare space as well. And so you had Michael Dawson and Roger Green. They were the promoters that sort of brought PHM to market, and had a lot of success with that, but they had a few missteps. And so that stock, I think, went from 5 cents to $1.70, and then back down to, I don't know, probably 15 cents. And so there were a lot of people, a lot of fund managers that made a lot of money on that stock on the way up. And then on the way down, there were a lot of people who were pretty upset because they had done some raises at, I don't know, probably $1.30 and $1.50. I don't know what the highest one was, but that might have been it. And then they sold some stock at the kind of near the top, which people weren't too impressed with. But the way they reported it, because I think they might have reported it together, Roger Green and Michael Dawson, they must have a holding company or something. So they each reported the entire amount, and it looked like they sold double what they actually did. I mean, they were still selling near the top, which, I mean, they can do that, right? It's not legal, but some people would think maybe it didn't look the greatest. And then, so then Biomed came out of there. And so Biomed was quite successful. I also own ProTech Health. That was sort of the rest of the patient home monitoring business that turned into ProTech. And now, so then Michael Dawson, Roger Green, they went and started a few other companies, and I think they're out of shells. They might have invented business in the shells, or it might have been through CPCs. And so there was a company called Inspira Financial, and so they were doing lending to the healthcare industry. And I just don't think they really found a product market fit and were able to scale it up. And so they sort of shut that down, preserved the cash. And so now, so they were sitting just on cash, and that was pretty much it for the last year and a bit. And so that's why I was buying. You could buy it. They had almost 20 cents in cash, I think 18 or 19, and you could buy it at, dip down, I think, to 9 cents in March, but, between 9 and 12 cents. And I thought, it doesn't fit into my Gulp investing, where it's growth at an ultra low price or unreasonably low price. But I thought that they were going to vend a business in there that would be a growth business. And so that's why I was trying to buy early. I thought I could get it at a discount. And then I thought, once they vended a business in, it might be worth, maybe 30 cents. And it's looking now, it's halted, but it's looking now like it's probably going to start trading at a higher price than that. They did a financing which management and some directors participated in at a much higher price than what it was its last trade. So they found the target company. They're trying to close it. They need shareholder approval and I think exchange approval. But it's kind of like PHM 2.0. And it's really interesting. Like right now, they have about 30 cents in cash after this raise. They've got about 65 million shares outstanding, and they're starting another roll up. And so I hope they can integrate these businesses better than they did in PHM. I think they've learned. There's the interim CEO, who I think is going to be the permanent CEO, at least for a while, is named Les Cross. And so he ran a company called DJO. Basically, they kind of a similar business to what Salona Global is doing now. And so they, he brought that public, I think, at about $17 a share, and they got cashed out about 6 years later for, I think, 50 some. So it wasn't a huge win, but it was a 3x. So he's come in, he grew that from, I think, 200 million business to 1.6 billion business. So he's done it before. He's going to be running this. He's got a lot of connections in the industry. They've got a number of targets at this point. So there's the usual risks with roll-ups. I mean, sometimes they can flame out, but it's seems like a pretty good management team that's kind of at the start of what could potentially be a pretty big snowball once it hits the bottom of the hill. So, so that's kind of my favorite idea. I mean, when it comes trading, it's probably not going to be cheap. Right. But if it comes trading, you know, if it's a reasonable price, I may even add some to it. So, so that's kind of one I like. We talked about Ready Shred before. I mean, that's run up quite a bit, and so it's probably, I don't know, I'm gonna run the numbers, but it's probably trading about nine times EBITDA maybe. So it's not cheap, but you know, it's really good, strong management team. Yeah, what else? Yeah, there's not a whole lot of value right now in the market. Yeah, it's really tough to find stuff. Yeah. So, you know, I mean, that's going to change. You wait a month or two, and eventually you get a rocky situation or some sort of sucker punch from out of the bushes, and so you usually don't have to wait too long. But yeah, these, I don't know, everything's run up. Like, I don't know, there's a lot of companies coming public too that are just, I don't know, I just wouldn't want to own them, and they're just going parabolic. You know, I sort of put those into buckets, like just it helps me filter them out a little quicker, so I don't have to sort of go through the steps. But you know, I'll filter them into, like, I think it was Francis Chu came up with the term of crap, can't realize a profit. And so, like, I think a lot of these companies right now are kind of in there. You've got like sausage stocks, and so you take the bits of everything that nobody else wants and you put it in a casing and you sell it at a premium. The worst ones are the sausage as a service stocks. So they look like SaaS businesses, but they're not. And then, as you know, like, there's a ton of like zombie companies trading on the exchanges, and so, you know, you pull up the financial statements and it's like you're looking to see in the footnotes to see if the numbers are in thousands, and they're actually they earned $1,400 in rent. They had $1,400 in revenue last year. Like, I just don't know how some of these companies can stay public, but and then you know, there's some companies I'll filter out too that you know, I used to invest in a lot of smaller companies with just a small amount of revenue, but I don't know, you would know better than me what the costs to be public are, but like some of these companies with a couple $1 million, if they're not growing, like, I don't know how you.
No, for sure. There's a couple companies out there that, you know, they're decent little businesses, but they should not be public. I mean, if they were private, you know, they would actually make money. And so it doesn't make a lot of sense, but no, I agree with you there. No, that's awesome. Listen, Chip, that's fantastic. We're sort of running out of time here, but you know, maybe leave with one thing. You've been at this for at least 20 years. You know, very, very successful as a microcap investor. But if there's one sort of takeaway or one message you think that sort of, let's say, younger investors that want to do well in microcap space, what would that message be? What's advice you'd give somebody who's just sort of starting out right now?
Yeah, maybe I'd break it down. Maybe if I can give two things.
Sure.
So the first one is, I think you have to learn, if you really want to do well at investing, whether it's microcap investing or anywhere else, you need to learn how to learn. And so, you know, you need to learn how to read books. And it sounds funny, but there's a book by Mortimer Adler called How to Read a Book. And it's just trying to pull information out of these sources so that you can use them. You know, investing is pattern recognition. And so I think you need to learn how to recognize the patterns that end up in successful stocks. And right now, you know, if I'm a young investor right now, like pattern recognition is totally screwed up right now because a lot of the worst stocks are going parabolic right now. And so if you're a new investor, you're seeing that and thinking, well, this is what works in investing. And so I think you need to go back and you need to do case studies on the best investments. And so, you know, in the microcap space, like we talked about the bioscience and the Expels, Great Horse Capitals, and even, you know, larger companies like Amazon see sort of what patterns and what worked in the past. And I think, you know, you can read, I wrote a case study on MTY for the Microcap Club, but you can read about these things, but I think you need to go back, like, you know, to 2001 and look at the financial statements of MTY and say, you know, what does this look like in real time right now, and follow that all the way through to another 10 years. And you need to put in that time. You know, Eddie Lampert, I think he's one of the best investors of all time until, you know, he had a pretty big misstep with Sears, but he compounded his hedge fund at 25% over like 20 years. And he spent his first 10 years, 50% of his time was doing case studies. There's a guy that I would recommend if people are interested, Yen Liao. I think it's RBAC Capital, but he's just started posting on Twitter. LIOW, I think it is. But he's done a couple of videos. If you watch his videos, he's done some podcasts, and he talks about the way his firm does these case studies. And he's been doing this case study thing with all his analysts for 10 years. And so it takes a lot of time, and a lot of investors just aren't interested in sort of getting to that sort of elite level of investing. But I think you need to do that if you want to become a great investor. And then the second thing I'd recommend is keeping an investment journal. And so I've done that off and on. The last couple of months I started again. And it's really interesting because I went back to my investment journal from 2015. I was just looking through that the other day, and I owned Bioscience at the time. And so I went in there, and it was trading around what it is today. And so my thesis was confident that this could be a 10-bagger in the next 10 years, and likely, or base case, to earn $1.10 in 2020. And so I don't know, I haven't looked what they're going to earn this year, but it's a lot lower than that. And so it's interesting, like if you can keep your investment thesis, maybe you jot down a few of the risks, maybe your target price and what would sort of make you sell. And then the other thing I would do too, and I learned this from reading a book called Super Forecasting. I don't know if you've read that, by Phil Tetlock. And he talks about, I think it was him, he talks about just in your investment journal, putting down the percentage certainty you have on these decisions. And it's interesting to go back in time and just see how accurate you are on these. And so when I was going back through the 2015 journal, I was pretty good on figuring out what the risks were at the time, and the ideas that didn't work because of the risks that I identified, but my certainty was a lot higher than on kind of my forecasts than I think what it should have been. So those are the two things I'd recommend.
Perfect. Listen, Chip, this has been great. I want to thank you so much. It's good to catch up, old friends. So yeah, thanks for being with us today. Thanks for all this, and mean, do you write a blog? I know you're on Microcap Club, but
I keep a pretty low profile.
you do.
I don't do this very often, so I find that, you know, I've got a limited amount of time, and so you know, if I'm posting on forums all the time, then I don't have the time to do the research. But it's something I would like to do a little bit more of, because I know, you know, you can't take from the community, you absolutely have to give some back. So, but hopefully we can get together soon at your conference, or LD Micro, or the Microcap Club conference soon here, once hopefully things open up. So
that'd be great to do for sure. Chip, thank you so much for joining us today. And let's stay in touch.
Yeah, sounds good, Paul. Okay, thanks, Trev.
Cheers. You bet.